From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, foreign policy whipsawing markets, a hot economy keeping the Fed on track as President Williams talks down a 50 basis point move. We begin with the big issue, whipsawed by geopolitics.
The developments between Russia and Ukraine.
This is a big air pocket of uncertainty.
The headlines have just been flowing fast and furious.
The uncertainty of the geopolitical risk.
Markets know that this is not good.
Markets are clearly up and down.
Struggling to connect the dots and really understand how bad this is.
Another reason why the Fed's going to be very, very careful.
If Russia does invade Ukraine,
all bets are off.
50 bips is completely off the table.
That's the kind of thread the market is pulling on.
Anything can derail this Fed.
So there clearly is downside risk.
Clearly, what we're seeing is that the situation is very hard to read.
Joining us now is Morgan Stanley's Brian Weinstein, Nuveen's Tony Rodriguez, and Amanda Lynam of Goldman Sachs. Amanda, let's just start right here on the Fed issue and the geopolitics, but keep things simple. How do you think the energy story is influencing the Fed's thinking at the moment?
Sure. Thanks for having me. So, our economists are expecting Fed liftoff in March with 7 consecutive hikes through the course of 2022, 25 basis points each. I think their base case is not for a 50 basis point hike. As you can see, there's a lot of uncertainty going on in the geopolitical landscape. But leaving that aside, their view is that the Fed is really focused on inflation at this juncture. And I think drilling down under the surface, some of these geopolitical concerns actually have the potential for to drive an increase in oil prices. And so that could further fuel kind of some moves under the surface. But in general, I'll defer to our economists in terms of their forecast for this year. But the base case is a liftoff in March, 7 hikes, 25 basis points each, and then an announcement of balance sheet runoff in June.
Tony, let's start with size, 25 or 50. The New York Fed President Williams just spoke moments ago, and I think it's fair to say he just poured some ice-cold water over that argument from his perspective at least. Quote, "We clearly have opportunities to take policy actions over this year starting in March. Personally, I don't see any compelling argument to take a big step at the beginning." Tony, that's loud and clear, isn't it?
Well, it certainly seems to be, and 7.5% headline inflation, I guess, isn't loud enough of an argument. Our view is that it will be 25 basis points. Our view, when you think about Fed speakers, is that despite hearing from many others, like Bullard and others, that listening to what Williams, Brainerd, Powell say is really going to be more critical to determining what the actual path will be for the Fed. So we think that they would like to be gradual. They would like to be able to be pretty well telegraphed. And despite the fact that the market is already pricing in a quite high probability of 50, we still think the more likely path is for them to start out with 25 and then continue consecutive meetings pretty much throughout the year, although we think they may end up only doing 6 hikes this year rather than the full 7, which would be 1 at every meeting.
Brian, I think that's a no from the likes of President Williams, a no to 50 basis points. What say you?
Yeah, I think it's a no. I think there's just too much going on in terms of energy as a tax on the consumer, right? And the market has done a lot of work pricing in 7 rate hikes, so rates are higher. So I don't think the Fed wants the market to believe that 7 is the beginning. I think between 6 and 7 rate hikes, they're happy. And so to go 50 here, well, logical with inflation where it is. Remember, the Fed is still buying bonds. So this is a gradual process. They have other tools. It's a bit of an experiment how they use them. And so I think 25 to start.
This argument about what would happen if they don't do 50 in March, I find quite interesting. I think the intuitive response from markets is a rally, that we get this kind of dovish move from the Federal Reserve. They don't do the full 50, they wait, they go gradually okay. Bob Michael at JP Morgan Asset Management said this earlier this week. Any idea that you could invest in risk on through credit or equities, that goes out the window because the market will lose confidence in the Fed. Amanda, can I get your perspective on that? This idea that maybe you get an adverse reaction in markets, in credit, if the Fed isn't seen to be getting a hold of the narrative around inflation.
Right. I mean, I think a lot of this, in what we're seeing, at least in credit markets, has been priced in already. We've seen some pretty notable moves in certain duration sensitive pockets of the high yield market, for example, double Bs are a great indicator of that, significantly underperformed both the lower quality spectrum of high yield as well as their higher quality triple B counterparts. We think that's overdone. And so we would use that as an opportunity to buy risk. But I think, the credit market is definitely seeing some moves on the back of a reaction function of the Fed that is very focused on inflationary upside risks. And so I don't think the credit market at this juncture is really concerned that there's a recession risk or a growth slowdown. If it were, we wouldn't see the outperformance of triple Cs like we have been. But it's definitely responding to a less accommodative shift in policy, which we think is appropriate. And we actually, in our forecasts, are forecasting some additional buildup in risk premia through the end of the year.
Brian, your thoughts on the same question?
I don't think the markets will be that upset about a 25. I think it depends a bit more on the data, right? We get a March payroll. If that's unusually hot, then maybe I'm wrong and they do go 50. I think the Ukraine matters. Obviously, geopolitical risks matter. And listen, I think the yield curve is sending a message, right? The Fed is probably pushed as hard as it can on the front end. I think if they do start mentioning other balance sheet tools, the market may be happier with that. So we don't expect a big risk on or risk off 25 or 50. I think, again, when you get to that 6-7 rate hikes over the course of a year, it's more important what happens in 2023. Are they going to be easing and then is it a mistake, or are there signs that this is right? They're doing it correctly. They're telegraphing correctly. So I'm not sure we get a big risk off if they only do.
Hey, Brian,
25.
now you've thrown me. Are we talking about rate hikes or are we thinking about rate cuts in the future? What's more important here?
We're big believers that this is the beginning of something, not the end, right? Again, that's why the Fed wants to be gradual, right? They don't want to be, they're not raising rates just to ease them back next year. We think the market is sanguine about inflation being sticky, that the Fed will have to go further. But if you look at the market pricing, it's pretty clear, right? That it looks like they do it all this year and then the risk is actually tilted the other way. We would disagree with that.
Tony, Michael Hartnett over at Bank of America said this: recession risks are rising. We remain bearish on tech stocks, credit. Next 6 months, the rate shock morphs into a recession shock. Tony, your reaction?
I think there's certainly some risk of a recession, although we happen to think that's more of a 24 risk than a 2023 risk. Now, if you tell me they go 50 and you end up with hikes at every consecutive meeting after that and another 5 or 6 next year, then that recession risk certainly moves forward into 2023. We think the Fed will be a bit more gradual than that, call it 6 this year, maybe another 2 or 3 next year. The terminal rate ends up a little bit below where it's currently expected by the Summer of Economic Projections at 2.5. And then you just have a moderating growth trajectory as opposed to recession risk. So I think it really matters about how much you end up seeing this year. And the key to that is going to be, do we begin to see moderation in inflation in the second quarter of this year? If we don't see that, then we will see a more aggressive Fed, and it will lead in our minds to over-tightening and a significant slowdown, possibly recession, in the second half of 23.
So, Tony, do you take the Mester argument at the moment? Bullard's talking about a front-loading of rate hikes. Mester's saying, wait, let's see how the inflation story evolves through the summer into the back half of the year. Then we can backload them if we need to. Is that where you're at?
That is where we're at. That's why we think it'll be 25, and we think they end up with only 6 this year rather than the 7, which would be 1 at every meeting, because we are expecting to see moderation inflation. We're thinking 3.5% on core PCE by the end of the year. Williams today commented expecting 3%. We think that's actually optimistic. But we do think that if you see the moderation heading towards 3.5, given that the fiscal impulse is also declining, and we look out into 2023, and we think growth moderates still further, closer to potential growth, that's an environment where the Fed, we think, can be very patient and very gradual and not disrupt the economic growth potential of the economy.
Amanda, something you mentioned just on the credit side of the story I think is interesting for a lot of people not in your world. The double Bs have lagged, and you're looking for this evolution of an up in quality trade through the year. Can you walk us through your thinking there?
That's right. So year to date, double Bs, which are the highest quality pocket of the high yield market, have really underperformed. And they've underperformed on a bunch of different measures: risk adjusted, unadjusted, excess returns, total returns, you name it. And they've underperformed triple Cs, which are the absolute lowest quality of the high yield market. And then they've also underperformed triple Bs, which are their investment grade peers. And so when you take a step back and you look at why that is, we believe that it's really an aversion to the duration risk that is in the double B pocket of the market. As we know, a big wave of fallen angels moved from the investment grade market down to high yield in 2020. You have some very long duration capital structures in some of the biggest sectors in that market, like energy and food and beverage. And what we've seen is that in an environment where we still think default rates will be benign and where interest rates are poised to rise, we've had investors prefer either the lower quality pocket of the high yield market, so triple C's over double B's, or prefer the triple B pocket over double B's. And they've really left this double B pocket really by the wayside, and it's underperformed significantly. What we're expecting as growth moves closer to trend over the next 1 to 2 years is that investors will move up in quality, as you alluded to, back into that double B pocket of the market. And so that should really favor double Bs over their lower quality triple C peers. And then for kind of the crossover investor that has the ability to invest in both investment grade and high yield, we prefer double Bs because we think that the risk premium in that asset class is especially more attractive after the underperformance, but attractive in general because, again, we're expecting a big pocket of that market to migrate back up into investment grade over the next 3 to 6 months for some structures. So
for people outside of credit, Amanda, what you just said, I think might have been lost on them over the last few months. Brian, that's been a surprise for many people. When you tell them that the junkiest of junk is where the outperformance has been. The final word from you, please, Brian.
Yeah, listen, our investors are speaking with their feet, right? The flows are into floating rate, into loan funds, right? They're out of high yield, out of traditional bond, into short duration, right? The front end of the yield curve has a lot of protection now, given what's priced in. Listen, we think the duration trade is not over yet. The risk is still that the market prices in higher terminal funds rate, more risk to 23 and 24 being better. And so there'll be a time to buy higher duration assets. We don't think we're quite there yet.
We're going to go back to Amanda on that in just a moment. Amanda Lynam sticking with us alongside Tony Rodriguez and Brian Weinstein. Coming up on the programme, the auction block, geopolitical uncertainty keeping the primary market on hold. That's next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where as always we kick things off over in Europe. The banks dominating issuance this week, with Crédit Agricole and Deutsche Bank helping the financials account for roughly 40% of weekly sales. In the US, high-grade bond sales topping estimates despite a zero-deal Friday, a midweek burst of issuance propelling volume to more than 31 billion. And in the United States junk bond market, grinding to a halt amid surging volatility. Monthly sales now on pace to record the slowest February since 2009. Keep an eye out on that. Brian Weinstein, Tony Rodriguez and the brilliant Amanda Lynam still with us. Amanda, let's start there. For some people, maybe a flavour of Q4 2018 starting to emerge, December 2018. Would you push back against that?
I mean, we are starting to see, I would characterize it as some flashing yellow signals in market microstructure. As we talked about the significant outflows from high yield mutual funds and ETFs year to date, it's been remarkable. And so it's really caused, we see some weakness in illiquidity measures in the high yield bond market, more so than in the investment grade landscape. We're totally on board with the idea of additional tailwinds behind the leveraged loan market. But I do think high yield is in a relatively more challenging spot on the technical side because of that. But as you know, our forecasts are calling for a slowdown in supply anyway this year. We're forecasting 325 billion, which is a significant decline from the 2020 and 2021 run rate. So I think corporates have done a lot of the balance sheet repair. They've done a lot of the refinancing. They have significant cash on balance sheet. So there's not the same pressure for them to tap the debt markets like we saw for the past 2 years. And so I wouldn't necessarily read too much into a slowdown in supply. Where we would be concerned is if the debt capital markets were effectively shut. Obviously, that would be very concerning to us. And then we're keeping a close eye on the market microstructure front.
Tony, let's talk more about that, what Amanda just mentioned. Just these little cracks, a yellow light, maybe amber, on its way to red. I've got no idea. Tony, but what's happening in this market is happening even though the Fed is continuing QE. They've not hiked yet. Balance sheet reduction hasn't started. I've heard massive numbers, 1 trillion at Bank of America for this year, for next, another 1 trillion. We haven't done it yet, Tony, and these things are happening. What's the signal there for you?
Well, I think the key is that some of it is actually happening in the markets. So the markets are doing some of the work in advance of the Fed, obviously, with the rate increase that you've seen in the 2-year and in the 10-year, with the widening in spreads, tightening financial conditions from that direction, the weakness in equities. So the market's clearly already pricing in quite a bit of this. So from our perspective, the pressure right now, as Amanda mentioned, it's not on fundamentals. We think corporate fundamentals are going to be in pretty good shape, whether it's cash flow, balance sheet maturities, debt leverage levels, et cetera. We think defaults stay low. We think upgrades are going to outnumber downgrades. So the fundamentals are solid. But what you're running into is a macroeconomic environment that's getting a bit weaker, and the uncertainty level on policy and geopolitics is very high right now. And so therefore risk premiums certainly need to be higher. We think we may have already priced in the maximum amount of widening that you're going to see across some markets, and that as things begin to settle down in the second quarter, third quarter of this year, you could begin to see risk premiums both stabilize and possibly tighten a bit from here.
That is a very constructive point of view, Tony, there, Brian. Would you agree with that? Can you really say we've seen peak wides in some markets, even though we still don't know how big balance sheet reduction is going to be?
No, we're not as sure. I mean, listen, the balance sheet question is fascinating, right? Obviously, the market is pricing in that they're going to stop easing, but they're still easing, right? They're still buying bonds. It's a strange concept. I think the market doesn't like that, right? If we have an inflation problem, why keep buying bonds? So I'm not sure it's helping anymore, and certainly we're not priced for it anymore. But what happens if they decide that the primary tool is the balance sheet? I don't think we're anywhere close. It's a conversation for probably June. But if the Fed raises rates a few times and the yield curve gets too flat and they have to sell assets, where do those assets go? Right? We've already seen mortgages widen, mortgage rates are higher. I don't know. It is the question that I think does not get enough focus. 50 versus 25 gets maybe too much. But to us, we think there's more pain, more risk premium out there. It's not a fundamental story. Again, we were priced for the credit market to have low defaults. That's probably right. Now the question is, where do all the bonds go?
Well, there's a big change. Cash is becoming, as you put it, Amanda, an investable asset class. How much of a change is that already?
It's a very meaningful headwind, we think, for the front end of high quality IG bond spreads. And so the return of cash as an investable asset class, which you can see just in the move in the 2-year treasury over the past few weeks, it's causing some pressure on kind of the value proposition of staying in short duration IG high quality spreads. And so we think that will cause some curve flattening relative to intermediate maturities. We think the value proposition of front end IG paper is weakened. At the long end, we're a bit more constructive because we think that the structural drivers of demand for long duration spread product are more important than the shape of the treasury curve. Our work has shown that correlation between the slope of the treasury yield curve and the slope of bond spread curves has really broken down in the past few years. So we look at things like corporate pension funded ratios, which are at exceptionally elevated levels, actually above 101%, demand from yield sensitive buyers like insurance companies. We think all of that bodes well for the long end of spread curves. And so we just have a flattening bias across the board. We expect underperformance in the front end, and then we do still have the overweight on 30-year spreads versus 10.
Amanda, while we're here, can you weigh in on the loans versus high yield debate as well? You talked about that up in quality trade within high yield, back up to double Bs. Now we've got that yield pickup in high yield. What does the trade-off look like, loans versus high yield?
Absolutely. So that yield differential between high yield bonds and leverage loans has actually widened, as we talked about earlier. It's become more attractive. It's the most attractive or the widest since early 2016. All of that being said, we're still comfortable with the overweight on leverage loans versus high yield bonds, because if you take our economists' forecast, for example, for Fed hikes, roughly half of the leverage loan index will start to float beginning in May. And so we do think that carry proposition is really what is most valuable about the leverage loan product, even though the relative valuation between high yield has become more balanced as high yield has underperformed in recent weeks.
Brian Weinstein, your thoughts on the same topic?
Yeah, we tend to agree. We've seen the flows into leverage loans. We think the balance sheets are clean. You're going to pick up higher coupons. Again, if the duration trade continues to roll a little bit, if inflation is a little bit sticky, the story is loans over high yield for a little bit longer.
Tony, final word?
We also favor loans over high yield right now. Then we would probably send that into other kind of floating rate, lower quality assets. So we think the CLO market is also quite attractive at this time. So long duration, high quality assets are probably the least favored by us versus intermediate duration, floating rate assets, mid to lower quality as being outperformers for the rest of the year.
Tony, sticking with us. Tony Rodriguez alongside Amanda Lynam and Brian Weinstein. Coming up on the programme, still ahead the final spread, the week ahead, featuring talks between Secretary Blinken and Russia's Foreign Minister Sergei Lavrov. That conversation up next from New York. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. The words of John Williams, the New York Fed president: "I do not see a compelling argument to take a big step at the beginning." Was that a big glass of ice cold water thrown on top of the 50 basis point argument? Maybe it is from him. For others, for President Bullard, he'd like to see it. You assume. For others, maybe they would too. This meeting in March is going to be tense, I think, for this Federal Reserve. Can they form a consensus on what to do, not just for next month, but the year ahead as well? Do we front load the rate hikes a la Bullard, or do we wait and backload the rate hikes a la Mester? You work it out. I don't know. We still haven't talked about balance sheet reduction either. Let's get to what you need to look for through the next week or so. The final spread the week ahead. This is how we're shaping up. President Biden giving an update on Russia and Ukraine, 4 p.m. Eastern. Don't miss that. Plus Secretary Blinken and Russia's Sergei Lavrov meeting next week. U.S. markets closing for President's Day on Monday. Long weekend coming up. Look out for U.S. PMIs and fourth quarter GDP as well. And rounding out the week with Fed speak from Mester and Bostic on Thursday, and I imagine a whole lot more than that. Still with us, Brian, Tony, Amanda. Let's get to the rapid fire round. 3 quick questions, 3 quick answers. Let's start right here. March meeting, 50 or 25? Tony, 50 or 25?
25.
Brian.
25.
Amanda.
25.
How many hikes this year? Just pick a number for 22. How many hikes this year? Brian.
6.
Amanda.
We're at 7.
Tony.
6.
2's 10s curve, 40 to 50 basis points right now. What do we get to first? 0 or 100? 0 or 100? Tony.
0.
Brian.
100.
Amanda, you get the final word.
0.
Amanda, thank you. Amanda Lynam, Tony Rodriguez, Brian Weinstein, to the three of you, absolutely fantastic. Thank you very much. From me, from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield. You have a fantastic long weekend stateside. This is Bloomberg.